Hello, Mike Swanson here, and it's April the 17th, right after the closing bell, right after 4 o'clock. I'm going to wait 1 minute before I really get into the material so we can give people some time to come and get into this event. But I thought it'd be a good time to look over the stock market sectors and some of the individual stocks in the market to get a handle for what is going on and what opportunities there are going forward. I know a lot of people are extremely bullish on the market now. The NASDAQ, I think, was up over 100 points today. And Netflix, of course, really took off. We're going to talk about Netflix in a few moments. And you're going to see why Netflix right now is probably one of the most important, if not the most important, stocks in the stock market. A funny thing about Netflix, before I get into the presentation, and like this video too, if you would, so that I know that you're here. But one funny thing about Netflix is the company loses money. I was reading over its earnings, and everyone's talking about they've got increased the number of subscribers by 100 million or 200 million or whatever it is. But the company is spending close to $9 billion just to get more content or more new movies out there. And it doesn't have enough cash flow to do that. So it borrows massive amounts of junk bond debt. Now, I'm not saying Netflix is a stock to bet against right now. However, I'm going to remind you that this is the exact same story we heard about Tesla over the past couple of years, that this is a wonder company, that they're innovating, that they're going to take over the automobile industry, and they don't need to make money. They can just borrow money, and profits don't matter. And over the past couple of months, profits have mattered to Tesla, and Tesla has sunk as a result of that. Now, I'm not saying Netflix is Tesla, but if there ever came a time in which the cost for Netflix to finance its debt by what it does by issuing junk bonds goes up, if interest rates were to go up enough or the bond market was to drop at some point in time, Netflix would become under financial pressure and the stock would run into trouble. Netflix would have to either sell itself to a third party or raise costs on its customers dramatically or just cut its expenses. So we're in like a magic moment for Netflix of where they're able to borrow massive amounts of money, spend money, not worry about, just lose, and people are rewarding it. But it doesn't matter. I'm not betting against Netflix stock. I'm not saying you should bet against Netflix stock. So let's get into the charts, and that's why I would not bet against Netflix stock right now. So let me pull up this presentation and we'll get right to it. And I'm just going to double check, make sure you are seeing this. Okay, so what I want to talk about today is stock market. I'm going to show you how I analyze sectors, and we're going to talk about what could the new winners be and how do we discover the new winners. But here is Netflix, as I mentioned today, and the stock has gone straight up. I mean, we had a tremendous gap up, 8% gain by 3:13 p.m., which is when I put this chart together. Of course, it gapped up in January. It gapped up at the end of July, and it is a momentum stock. There's no doubt about it. If we look at Facebook, though, Facebook was the must-own stock up until recently when it broke down, and now it's below the 200-day moving average, below the 150-day moving average, below the 50-day moving average. It's now a laggard stock. Facebook was at one time the must-own stock, not anymore. But more importantly, Facebook was the F in the FANG acronym. Facebook, Amazon, Netflix, Google, that we were all supposed to own. And now Facebook is lagging. And I read an interesting article today saying that there are hedge funds, institutional money managers that are actually selling their Facebook stock because it's not a market leader anymore and moving some of that money into Netflix. So that shows once again why Netflix is so important. In the end, I talked about junk bond debt. I talked about the company losing money. But in the end, none of that matters. All that matters is price action. And as long as price action is this strong, people are going to buy, people are going to chase, robots are going to play. And that's the story for Netflix. But you're going to see as this presentation continues why Netflix is more important than Facebook maybe ever was for the stock market. But here, of course, is the S&P 500, up 31 points by 315. The NASDAQ was up 2, Dow was up. And that's exciting. It's exciting to see the market go up. It's exciting to see Netflix go up. Everyone's talking about Netflix today. But I'm going to shut up and show you when it comes to Netflix if there's other opportunities. However, I want to tell you that we spend so much time focusing on what's the price action today and the market's up. That's exciting. But all these moves have got to be put into context of how we got here. And we got here with a very vicious drop in January that took the Dow down roughly 10%. And the Dow and the S&P hit their long-term moving averages, rallied in March. The NASDAQ made a new high in March. But the Dow and the S&P did not. Then we reversed down in March, hit the moving averages. We've essentially, in my way of interpreting things, have been rallying off the 200-day moving average S&P 500 for really 2 weeks now. And we did that in February. So to me, this move is not very much different so far from what we saw in February. And I'm not really that excited about the stock market. I think the bullish case is that the stock market goes into a range. Say the S&P gets back up to 2,800. There's no guarantee it does that. And then it trades sideways for much of the summer and breaks out again later. But this could very well be the makings of a major top in the market that could be taking months to play out. And I really think that's really what's going on because I've seen signs of internal weakness. That doesn't mean, though, that some sectors are going to break away from the market action. I think we're actually seeing that happen. And I personally am not, making massive bets against the stock market. I do have some short positions, and I'll talk about that later, but I've got more long positions than I do short positions. I'm operating more like a hedge fund in the original traditional sense when hedge funds are made in the 1940s. The very first ones, they were called hedge funds because they went long and they went short, and we're sort of market neutral in that sense. And that's basically what I'm doing with my money right now because I'm not that excited about the stock market going up like it did last year. And then at the same time, I don't think it's going to crash next week either. So it's what it is. The big thing is we're in a trading range for the Dow, the S&P, and really the NASDAQ too. And it's creating a much more volatile market environment. And we got to figure out the big question of the year is going to be, are we going to break down or break out? But right now we're in this range. And short term, we've broken through the 50-day moving average today in the S&P 500. I don't think we've yet even taken back half the losses from the January high, despite the excitement. But the next resistance level, if we have taken that back, that 50% point is 2,800. It seems more likely to me that we're in earnings season. It's the first week of earnings season. The market tends to actually go up, and it's doing that, and then peak out even in bull markets during earnings towards the end, and then you get a dip back down. It seems to be the most likely case. There are some stocks that have been selling earnings. JP Morgan, Bank of America, Goldman Sachs, masked by the excitement in Netflix. But when we step back and ask ourselves, what's going on in the stock market so far year to date? Netflix is up 75%. 75%. I mean, that's an incredible gain, 75%. It's actually the number one gaining stock in the S&P 500 and the NASDAQ 100. Intel's up 16%. Another stock, as I'll show you, that made a new high today. Facebook, though, is down 4.5%. The triple Qs are only up 6.6% for the year. The S&P 500 at this moment is only up 1.1%. Just last week, it was down. TLT, the 20-year bond ETF, is down 4.2%. Gold is up 3.2%. Gold is smashing the performance of the S&P 500, tripling it and doing pretty much the same with the Dow, and up while the bond market is down. And I think gold is in a position where it can break out. It hasn't even broken out. Where if it goes through the 1360 level, I think it's just going to take off and become the story of the year. So to me, gold is very exciting. I know I talk about gold a lot, and I own gold, I own silver through an ETF, and of course I own lots of gold stocks myself. And Newmont's up 10.5% year to date. It's up more than the S&P 500. It's up more than the Dow. It's up more than most stocks are, as you're going to see in a few moments when we really look at what's going on in individual stocks. But GDX is actually even or slightly down a fraction of a percent this year, which is making people think, well, gold stocks stink. And the reason why this GDX is not doing as good as Newmont is because 8% of GDX is put into Barrick, which is down year to date, has been lagging, and Franco-Nevada has also had a dip in February. However, most of the large leadership mining stocks are doing very well. Another stock, I own Newmont, I own BVN, I actually do own Barrick, but BVN is up 16.7%. BVN is up just as much as Intel is up. So while there's all this fascination in the tech leaders, mining leaders are doing the same. And I think they're in a better position because they're not trading with the stock market. They are basing, here's GDX, resistance is really short-term 23, then 24. We break 24. I think it's going to have a huge, massive rally. In my way of thinking, the move in 2016 was the first leg of bull market. We've been consolidating since then between 21 and really 24. We break that consolidation, and we're going to just go up to the, in a great, huge move. And that's where I think the big opportunity to make money is. I know people want to chase the tech stocks. They want to get in Netflix. I know that can be exciting, but I'm more excited, frankly, about mining stocks that I use short positions in some individual stocks really as a hedge against market risk in this environment. And that risk, I don't think, is high for the next couple of weeks. Could become high before the summer is over, and that's why I monitor the market action so closely. But here's gold, resistance at 1350, really the 1350, 1360 range. I think it's worth noting that we just had those Syria airstrikes over the weekend, and gold did not just dump on the news, but it's pretty much holding near resistance, another good sign, and silver is actually in a more bullish position. But what will the next winner be? I know you've heard me talk about gold many a times, and asking that question is not about predicting the future. It's letting the patterns come to us. And in the end, the best way to identify what the next big winner is going to be is two ways. One, I've already done it, I believe, with gold, and that's to look for basing patterns that can lead to a breakout. And I think gold and gold stocks are in that position. This is, one could argue this is a reverse head and shoulders pattern of 5 years. But this is a simple consolidation going on for 1 year. And you look for consolidation patterns like that can lead to a potential breakout in a sector with leadership stocks performing very well already. The other way to look for what is the next big winner going to be is to look for the stock market to pull back, and then you look to see what holds up during a pullback, because what holds up during a pullback tends to become the big winner going forward. So if this is a consolidation phase in the markets, I think the odds are very low that the S&P is going to go straight up here to 2850 and break out and go to 3,000 or something without first spending weeks, if not months, basing here and then breaking out. But I honestly think it is more likely to roll over. But regardless, I don't want to try to argue that point. Many people, on this video are bullish on the market, and we got to watch how things unfold anyway. I'm not trying to, if you're bullish, I'm not trying to you change your mind at this point until we can really see these things unfold. What's more important, though, is how do you pick out the winning sectors? That's really what I want to teach you in this. And then I'm going to show you how I look through the sectors in a moment. But the best ways, let the market consolidate or pull back, test the lows or make a new low, have panic come in, and you look to see what holds up. And then those sectors that hold up tend to do the best going forward. For instance, in 2014, there was a correction that October, biotech stocks held up, and then they led for about a year. So I think it's too early at this point for me to say, outside the gold stocks, here's these sectors that are just in a great position. I can't do that. I wish I could do that right now because I know people want picks. They want to hear this is the next buy, but I just am not in a position to do that. I own Newmont, I own BBN and Barrick, and I own gold stocks. I like them, but I think they're the next big thing. But outside that, I'm really not sure. But let's look at the sectors. I got to go away from this presentation, and I'm going to load up TC 2000. You can get it at warden.com or freestockcharts.com. This is the software I use to analyze the sectors in the market. And I'm going to do that with you. You're going to see exactly what I, looked at before I did this video. And we're going to see what individual stocks are doing because some interesting stuff is going on right now. And it might show you more why I'm thinking the way I am about the overall market trends. So let me load this up and give me a second. I got to make sure you can see this. Here's a weed stock. And interestingly enough, the weed stocks are another example of a great breakout pattern. They broke out in September, October, and took off. This is I think the largest weed stock in Canada, and most of them look like this. So this was a great, wonderful consolidation pattern, and now it's a sector that is could be. It looks like the stock is consolidating, and if it were to break out again, I think it could go up again. So this is something I have my eye on over the next weeks and months. Is this sector? If you remember that Riot blockchain, which is I wouldn't touch now. But you can see it broke out in September, and so did these blockchain Bitcoin so-called stocks, and it did very well. But this company makes no money, and this whole sector was hype, and I wouldn't touch it at the moment. But it broke out of a base, so that's the kind of stuff I want to look for: things breaking out of a base or things holding up when the stock market pulls back. I just wanted to re-emphasize that point. But how do we do sector analysis? So this is TC 2000, and it enables me to create a watch list out of all the sectors in the market. And it's got 241 sectors. And if you press shift, so here's one processing systems. If you pressed shift T, my cursor, I don't know if you can exactly see it, but it just turned into a cross, and I'm going to draw a line on here which creates a timeline. It enables me to sort these sectors. I'm just going to do it by year to date. If we were in the middle, if it was 2 or 3 months and I thought we've completed a stock market consolidation phase or a pullback was over, then I would rank from the peak of January to that consolidation moment, but we're not there. So I'm just going to, just for the sake of showing you how this works, we're going to analyze the market year to date and sort. So I'm adding a column. This is their watch list of 241 items, and I'm now ranking the sectors by performance, and the top performing sector is music stores, building materials, internet, which is agriculture. Now, this is an interesting chart, which this, I would go and look and say, what are these stocks in here? Because this is one that potentially came out of a long base, and maybe we're seeing consolidation. So that there's a candidate for some potential breakout stocks that I like, a pattern where you've come out of a long base and now popped up and consolidating. Potential right there. So that's a potential leading sector, especially a couple months from now, this is still consolidating or the market pulls back. But let me show you another way to look at this. So these are the leaders. What I like to do, since I'm shorting stocks of a portion of my money, is I actually like to flip this around and let's look for the lagging sectors when the market's rallying. So let's assume that this market rally that we're seeing right now, is going to peter out in a week or two or three, and it's going to be time to find stocks to short. You want to do the opposite. You want to find stocks lagging the market when the market rallies, to find stocks to bet against. So let's flip it and look at the laggers. And we got dairy products, wholesales, recreation vehicles, barely rallying on this. It's stocks such as Harley Davidson, wholesale computers, Dell, home furnishing, meat products, consumer services just looks like it's going sideways. Healthcare. Notice this, though, is a REIT. REITs are among the worst performing sectors in the market. Housewares, jewelry stores, another REIT. REITs across the board are among the worst performing sectors in the entire stock market. Now, one interesting thing about that sector is, I'll show you something in a minute. CAT systems, rubber and plastics, aluminum, water utilities. This is an interesting sector because it did so well last year. It was really a leadership sector, and since the peak in January, it's been lagging. So that's one that's, I think, a troubling sector. Cigarettes. Stocks like Philip Morris are very interesting too. RJ Reynolds, because they really took off and now are lagging. And it's got a very negative looking chart below the 200 and 150-day moving averages. Drug stores, tobacco again, auto parts stores. This is the kind of analysis, though, that I usually spend at least once a week, half a day doing, going over sectors, going over stocks inside the sectors. It gives me an idea of what is really happening. Honestly, looking at just the S&P, the Dow, the NASDAQ, it's not enough. And it's very difficult to look only at them and make predictions on where things are going. And that's, way too often what everyone does, much less looking at it, what the market does one day and trying to draw too many conclusions from it. But I want to show you, so there's the real estate group as a whole, really broken down, went below the moving averages, now trying to rally back into them. And that's my favorite pattern to bet against stocks, is stuff that breaks down, then rise back into the moving averages. Essentially, Facebook is doing that in Tesla right now. I'm short Tesla, by the way. So interesting things happening. Now, I want to show you something else. If we rank, I'm jumping ahead. One more thing I want to show you about this. Okay, so we're ranking all the sectors year to date. And notice this. This is how much they're up or down on the right. So 113 out of 241 sectors are down. That's a lot that are down year to date. Almost half of the sectors in the stock market are down year to date. You might be wondering, before I want to show you what individual stocks are doing. Oh, I did show you the leaders earlier. So here's oil and gas. Is that a buy point? I really can't tell you by looking at that. And that's why it's tough to just buy purely into strength during a stock market rally. It's much better to buy on a pattern breaking out or on finding what's holding up during a dip. I really can't tell you if this is a good buy or not. this is a good, I don't know, is this only going up just because the market's going up at the moment? I'm not really sure. Ideally, you want something breaking away from the market when it's pulling back to find the optimal, the best entry point. Really, I just want the best entry points when I put my money to work. I'm not into just trading every day just to do it. Okay, now I want to show you something interesting. So Netflix is the number. I pulled up that. These are all the stocks in S&P 500. Netflix is the number one performing stock in the entire S&P 500. Okay. After Netflix is this. Xi Capital looks like it got bought out. This biotech, Seagate, Red Hat, Adobe, Amazon, Micron, IDX Labs, Autodesk, NetApp, Dr. Pepper's one that got Edwards. So these are the top 16 I've gone through. And so there's 27 stocks in the S&P 500 up 20%. 27 stocks up 20% or more. This is where I want to show you something very interesting. 97 stocks in the S&P 500 are up over 10% or more. 97 stocks, okay? Really, though, this is what's crazy. Look at how many stocks are down year to date. And there's more are down below the 200-day moving averages. But inside the S&P 500, 251 stocks are red. So half the stocks in the S&P 500 are red year to date. I'm not going to say they're all in bear markets. I define something in a bear market being below the 200-day moving average, and those moving averages are acting as resistance. On this one, it's just right at the 200-day moving average, right? But on something like UPS, it's pretty substantially below the 200-day moving average. This one is just testing it right now. These are way below the moving averages. Dominion Energy way below the moving average. Here's Harley Davidson. Remember, is a recreation vehicle group. I know that. But so what this is showing us is that half the stocks in S&P 500 are red. 20% are up 10% or more. And what was it? So 27 were up over 20%. The leadership is very, very narrow to a few stocks. Really, 30 stocks are providing the leadership. Now, if we look at the NASDAQ 100, we'll see something just as interesting, even crazier. So here's Netflix, the top performing stock in the NASDAQ 100. Then it's Seagate. Then it's Adobe Systems. Then it's Amazon. Then it's IDX Labs. Micron, a very important stock. To Autodesk, up 26%. This bank stock, NVIDIA, Algen. But we used to would have Google on this list. We used to would have Facebook on this list. We used to would have had Activision on this list. Those stocks have dropped out. And when it comes to the NASDAQ 100, 10 stocks are up. And most of these stocks are overlapping with the S&P 500 stocks that are providing the leadership. So the leadership in this market is really now with, let's say, 10 big cap tech stocks led by Netflix. Netflix is now the most important stock in the U.S. stock market. It is now a leader. If Netflix, and I'm not saying this is going to happen now, but if one day in the future Netflix were to break down like Facebook, it would be a very devastating sign for the stock market. But if we study these stocks even more closely, something interesting also becomes apparent. Here's the top 3 making new highs. Amazon's not really on a high. Amazon's actually had a sharp drop at the end of March, and up until today was actually lagging. Micron, same story. Micron has been a leader up until it had a sharp pullback, and it's been lagging the past couple of days. Autodesk, same thing. NVIDIA, interestingly enough, it's been slightly lagging the market averages too. Once this even shows that even among the leaders, The real momentum is just in a handful of stocks. Now, this doesn't mean the stock market's going to crash tomorrow, but it shows us how very narrow the rally is now becoming. When Trump won and the Dow went through 20,000 following his election at the end of 2016, almost everything in the stock market went up. It was a massive, broad-based rally. In fact, there were lots of things that had been lagging badly in the stock market for 2 or 3 years in bear markets of their own that after Trump won, ignited, busted out, and went up for about 10 months. That REIT sector basically did that. Home healthcare sector did that. Lots of transportation stocks did that. The home builder stocks did that. A lot of those sectors, though, are now lagging. Then they've been doing that, especially since the peak in the Dow in January. Some of them have been lagging really since August. So the market structure is not what it was in the first 6 months after Trump won. It's a different market environment than it was last year. So that leaves, I think, all of us with choices on how we're going to navigate that kind of stock market. Honestly, most people most people are asleep. They're not really paying any attention. Their investments are kind of like on autopilot. They've got their money in a couple ETFs, and they just ride things out. They don't really pay much attention until there's a big drop. Then they go, oh, what's going on? And panic. That's really what the masses do. But the other group of people are the traders that are kind of manic. They chase momentum, whatever is up the most that day. It's really what you see them talk about on Fast Money. And so Netflix is the obsession of today. Facebook was the obsession of last year, and so forth. So they are going to want to trade those stocks. And that's what, most people a lot of the people that go on my website are just trade, in the trading market or world going to trading websites. Their investment websites, it's what they want. Honestly, I have no strategy to trade Netflix. I just don't, and I'm not going to pretend I do. I just don't. I have a position against Tesla. I'm looking to do one probably against Facebook, but I don't have a strategy just to buy something, 10 stocks just because they hit a 52-week high and hope, they keep going up. And I don't think it's a good strategy. You got to know when you're going to get out. I like to short, operate like a hedge fund's what I'm doing, short stocks that break down, then have dead count bounces. So I'm going to be watching how multiple situations trade out over the next couple of weeks for those kind of chart lineups. And then I look for sectors breaking out, not really trading with the stock market. I believe that's what gold is going to do this year. Or I look for sectors that hold up when the stock market drops because they tend to lead after a correction. And I don't think this drop or consolidation, whatever you want to call it, is over with. And in fact, I think there's danger signs in the stock market with what I've shown you, the leadership being so narrow. That's really the kind of stuff you see at the end of bull markets, or doing what I believe is probably a stage 3 topping phase, much like August to November 2007 or something. But that's, that's kind of like guessing, right? We don't need to guess. We can watch this thing unfold. And the market is sort of, I think, I know the day-to-day action can seem dramatic. We saw the Dow fall 1,000 points in January the other week. It also had a big drop in March when it pulled back. That was just 3 weeks ago. But now we're bouncing above the 200-day moving average. The Netflix brings lots of excitement today, but tomorrow the market could be down. All I'm saying is we can't make too much out of individual down days in the market or up days, because we're in a market that's in a range at the moment where a lot of fake moves are happening. When it falls down to the bottom of the range, it looks bad. And then when it has an update, like, it looks wonderful. When in reality, I think we're really watching something unfold in slow motion, and analyzing it on a weekly basis, I think is the key to, being patient and understanding what is really going on with the overall trends of the market. And that's the work I do every single weekend to try to keep on top of everything. So that's kind of what I wanted to talk about today. I showed you I don't really have any stock picks at the moment, but we have to be patient, let things unfold, and then trading opportunities come to us. So that's my thoughts for April, and we'll be keeping in touch as things unfold.